Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on options trading using technical analysis with the Montreal Exchange. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your toolbar. Also, if you are experiencing audio difficulties, you can click on the sound check link or the settings link in your audio panel, and the setup window may show up on your secondary screen. As always, everyone is muted for sound quality purposes. And thank you, Sunny, for confirming through the chat box as well. So if you can't find that hand icon, feel free to confirm in the question or chat panel as well. And also, if you are experiencing some audio difficulties, you can always join us by telephone, and don't forget to enter the access code as well as the audio PIN. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. So we did get a chance to use the toolbar here. I just want to note that in the GoToWebinar platform, the control panel sometimes is hidden automatically. And if you want to make it visible again, you can always click on that arrow icon to show or hide the control panel. Also, you may view it in full screen mode by clicking the full screen icon, and as well as the hand icon, feel free to click that if you have any questions or just want our attention. And as always, you can enter your questions or comments in the question panel, and our presenter will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access our past webinar recordings on our webinars on demand page under the Learn and Do More section of scotiaitrade.com. You are also welcome to take notes. However, we'll make today's presentation available for you to download at the end of the session. I do want to note that it does show up in the handouts panel, which is not currently visible, but will be at the end of the session, and you can click on that link once available. And today's webinar is part of a learning series that Montreal Exchange offers. It is part of Series 2, Part C, on why use options. And if you didn't get a chance to view any of the past webinars in this series, feel free to access them on the Webinars on Demand page so that you may catch up as well. And our presenter today is Patrick Ceresna. He's been providing education on behalf of the Montreal Exchange for several years. Patrick specializes in analyzing the inter-market relationships of the broader derivative markets and the impact those trends have on trading and investment decision-making. In addition to being an instructor, he's the Chief Derivative Market Strategist for LearnToTradeGlobal.com. He's also a Chartered Market Technician, Derivative Market Specialist, and Canadian Investment Manager by designation. Welcome, Patrick.
Hi, Rose. How are you? And hello, everyone. And thanks. That's good. Thanks for joining us, everyone. Yeah, so I'm just going to quickly get my screen shared here. All right. Perfect. Okay. So, Rose, you can confirm that you see the presentation slides?
Yes, I can.
All right. Perfect. Okay. Well, hello, everyone, and thank you for joining us. Today's a very interesting topic for me as I have both a lot of experience in utilizing technical analysis and a lot of experience in using options. And in general, I think that the two do a very good job in complementing each other. And the reason that is because unlike stocks, which an investor can naturally buy and hold, an option has an expiration. And by having an expiration date, there has to be an element of timeliness to the utilization of the option, as you have to be right within the time frame that you specify, and therefore technical analysis is a very natural complement to options trading, and the two very well go hand in hand as you're using it. So as always, the examples that I'm giving are for educational purposes only. It should not be used as advice. So today we're just going to do a focus on the introductory level of technical analysis. We're not going to get into within an hour into any sophisticated approaches, but rather just give everyone a conceptual idea of some of the different ways that you can begin to use technical analysis with options trading. And so we're going to cover everything from what is a price chart to the types of charts that are available to you. What are some of the basic trend identification things we can utilize? We're going to discuss a traditional indicator such as moving averages. And we're going to also observe support resistance levels as a way of being able to make different investment or trading ideas, particularly when utilizing technical analysis in the buying of options and or the selling of options through covered calls or put selling and so on. So with that said, let's talk about technical analysis. And one of the key things that I would more or less want to differentiate is that, first of all, there's nothing wrong in fundamental analysis. A lot of people build there to be this big battle between the fundamental traders versus the technical traders, and I believe that there's a very happy median between both. And the reason that is because fundamentals matter, and you should understand them. But over any short to intermediate period of time within the markets are far more influenced by liquidity within there in the price discovery process than they are over on those fundamentals. I love that old saying that was repeated by Warren Buffett, but obviously I think it comes from Graham and others, but it's about the idea that the market over the long term is a weighing machine, but over the short term it's a voting machine. And that's always an interesting way for me to always present it, is that in order for us to have a very good idea of how the liquidity of the marketplace is shaping up and whether the market is more poised most likely to go higher or lower, is something that is beyond fundamentals. It's about understanding the way the price action itself is trading. And this is where bridging that gap between fundamentals and price is very well done with technical analysis. With that said, like that first statement on your screen, there is no holy grail trading technique. It's not that technical analysis is some way able to see into the future and guarantee you a result. What the technical analysis does is it gives you the ability to make a decision as to when you want to get in, where you can admit that you're wrong or where you're right, and if you're right, where you're going to take your profits. It's a mechanism from which you can manage the way that you're in and out of a trade, and that is something that is a natural complement to those fundamentals. I always like to say I like to technically trade fundamentally good things, and there's room for them to be merged together. With that said, any technique, whether you that involves you entering the market, one has to recognize that what makes the true difference for investors over the long term is the application of sound risk management principles, because there is, with the notion of, or an understanding that technical analysis is not this holy grail, then one simply has to recognize that it may be a very effective way for an investor or trader to be able to just make good risk-reward decisions in the process of trading. And so our objectives today is to kind of identify what trends look like, use some basic technical analysis of how you can track that, and identify those support resistance levels. Now, the first thing that we want to touch on is being able to differentiate between the different types of charts that are available to you. Obviously, anyone who takes the opportunity to watch any media source will know that the traditional mountain or line chart is the traditional way that a price is observed. But there are more advanced ways of observing price action through what are bar charts and candlestick charts. And I'll show you an example of each of them. Nonetheless, what we want to do is be able to just show everyone what are some of the differences in the different ways that you can look at the markets and see the way that these look on the chart. So the first thing you can see here is a differentiation of how price looks on a chart. And so you can see here the line chart, or what, like for instance here, if I just show you on, if I just show you very quickly on the Scotia platform, this is also called a line chart or a mountain chart because it gives a color underneath the line. They make it look like a mountain. Nonetheless, the observation with a mountain style chart like this is simply the same concept behind this line chart that you see over here, which is this, which is just simply taking the closing prices and plotting them consecutively and connecting the dots to draw the line. Now, what makes a bar and a candle different? It's the same price movement, but it identifies a little bit more as to what the price was doing from a behavioral perspective during that time frame. And so when you're seeing all these different colors of bar candles, bar charts and candle charts, let's kind of explain what you're seeing. And when you see, now obviously from one charting software to another, the color associated with a positive candle may be different. Some it's white, some it's hollow. There's all sorts of different variants to it. We have chosen in these examples to make them green. And what a positive candle does is it implies whether it's a bar like on the right-hand side or a candle on the left-hand side, what you're seeing is that the opening price was at the bottom end of the range and the closing price is at the top end of the range. And the highest and the lowest that it traded is marked by that thick line down the middle. And it's black on the candle, it's fully green on the bar chart, but that's marking the highest and the lowest it traded. And the little side ticks on the bar, or the candle body on the candlestick, is marked by the opening and the closing price. What this candle signifies is the fact that there was a trend higher throughout this. For instance, if this was a daily chart, and we're observing the trend that that daily chart made during that time. So now, inversely, you have the negative candle and the bar, and the candle represents the same principal concept that that we saw earlier, but the only difference here is the fact that the opening price was at the top and the closing price was at the bottom, subsequently filling the candle with this red body on the downside, signifying that over that time frame there was selling. So if you look at that concept, when we go back 2 slides over here, you can see that the red candles signifying selling days, while the green candles are signifying the up days. And a lot of traders that use candlesticks this way are using them as a barometer of momentum, in a sense that if you have consecutive green candles, it's a demonstration that buyers are very active and motivated in that frame, and using red candles as an indication that a little bit of selling has ensued. Now, there's an entire art to the process of determining the candle, what the candles are telling you. There's books written on it. I simply, in today's presentation, want all of you to just know that these different charting techniques exist, right? And so if I was to kind of simply show you here, this is just using Scotia. Now, for some reason, because of a Java issue on this one computer, I wasn't able to launch Flight Desk, but I think that we can, and all of you can get an idea of what we're looking at. So notice here, for a short-term chart on Air Canada, you can see that the basic charting features here offered through this Recognia feature built into Scotia, you can see the white candle or as the up candle, and in this case the gold-filled candle as the down candle, and it's showing you the price behavior, for instance, on a candlestick basis of what's happening on Air Canada. You can see that you can also look at that as a mountain chart, the same way that we were observing earlier, or you can also look at it as a bar chart, which has got that same text. In this case, each of those bar charts themselves are all the same color on this particular charting software. Nonetheless, it allows you to have different ways to observe the price action. And so one of the key things that we do as technical analysts is we want to establish a directional bias by identifying a trend within the marketplace, and we want to determine a strategic entry point for an option purchase. So so establish targets for and exits for trade management and for strike price selection. We are assuming in this presentation that you may have watched our earlier sessions where we introduced everyone to what an option is. The strike price is the contractual agreement where one has the right to buy or sell that underlying security. So in this example, when we were using it from a selling perspective, some of you may find there being appeal in covered call writing or the selling of put options. And by the way, if you're not certain or if you're not certain of what those techniques are, there's a library of videos available to all of you on the Scotia iTrade platform, and I'm sure Rose can direct all of you to those, cover these strategies in greater detail so that all of you can kind of learn which one of the strategies you find most appealing to what investment objectives you're seeking to achieve. Nonetheless, when we're the seller of an option, one of the most important things to observe is where there's a major support resistance level. You want to always sell puts down along a support line and or often sell covered calls up along an overhead resistance level in order to create that optimal utilization of what are support resistance levels on stocks. So one of the key things that we do is we try to create trend identification. And trend identification, one of the easiest ways to be able to differentiate, obviously I'll show all of you a moving average, and we can certainly observe, let's say, moving average trends as a way of being able to identify trend. But in this case, we want to show you how to identify it by noticing the peak to trough cycles in market rallies and sell-offs, and looking for the up and down and sideways trends that emerge from that. So as an example, in this scenario, what you want to always observe is that during an uptrend, you will see that the markets are making higher highs and higher lows. That is a very common characteristic in that time frame. At the same time, you know, when you're looking at a downtrend, often one of the characteristics during a downtrend is every rally fails, it sells off, and subsequently breaks to a lower low, tries to rally, can't do so, and it goes basically back and forth in that way to try to always determine what is that trend. So we can use the troughs to draw a trend line during an uptrend. And so what do I mean by that? Well, notice here's a candlestick sequence of that uptrend. And virtually a trader often will do is literally draw a line along the previous little troughs of distribution that the stock has done to kind of identify a trend line that has more or less been in place. And you can identify that this is continuously being accumulated. Every time it has a short-term sell-off, it subsequently reverses, is accumulated, breaks to higher highs, and follows that same trend over and over again. Similarly, in a downtrend, you have in this example, you have a situation where the stock is perpetually making lower lows. Every time it tries to rally, it makes a lower high, and essentially continuously is breaking down into that trend. And you can identify the downwards trend. And so we're going to overlay a moving average on that to try to establish that trend. An example, for instance, sorry. So an example, let's just use, for instance, Agnico Eagle as an example here. So what I'm going to do here is I'm just going to pull up a Agnico Eagle chart. And what you can see here is that in this chart right over here, we can literally, I wish I could unpin this to just, actually, let me see if I can, if the zoom, there we go. There we go, we can zoom in on this. Okay, so what you can see here is that during this period from 2016 over through to August of summer, you see a sequential uptrend in Agnico Eagle. You can see that it is making higher highs, higher lows, and following a beautiful uptrend as it proceeded to go from $30 to close to $80 a share during that period. Notice as well how we were able to use just something like a 50-day moving average, which happens to be that blue line, as also as a trend identification. Now, what I was demonstrating earlier was the ability to simply draw a line connecting all of the lows. But you can see the moving average does very much the same job in terms of identifying the bottom end of its ranges. And what you can identify is that once in August that the trend line and or in this case the moving average was violated, the uptrend that Agnico Eagle has been in has now been transferred to a consolidation in a period from which Agnico Eagle has been in a downtrend and consolidating, sequentially making lower highs and lower lows throughout that time frame. And so it's about identifying the different up and down cycles within that trend. And so one of the techniques that one can use for that is looking at moving averages. And I use that 50-day moving average on that chart there, but one can very easily use any array of different ways of combining moving averages. In this case, I want to demonstrate the use of what's called a moving average crossover, which is actually a very easy chart pattern to set up when using Flight Desk on Scotia. And so when we're looking at those moving averages, what it's doing is arithmetically simply looking at what the average price has been over that time frame for just a straightforward simple moving average. So if you're looking for a 10-period moving average, you literally would take the closing price for the last 10 days, add them together, divide it by 10, and you now know what the average price has been. And that price gets plotted like a dot, and it trailers behind the price, identifying the primary trend, because it's a trend that's bullish, is going to remain above its average prices. And that identifies what is known as that primary trend. Now, what you can see here is that we now reference something called an exponential moving average. And an exponential moving average has all the same principles as a simple moving average, other than when traders want a price to react quicker to a change, what it will do is that the exponential moving average will react faster because it is exponentially weighting the more recent data to that of the past data. And so what it does is that the moving average exponential will react quicker. And so what is interesting about moving averages, because they're a lagging indicator, they tend to lag in terms of giving a major change in trend. So what a lot of traders have learned to do is observe when two moving averages cross so that they get more definitive buy or sell signals. So what you can see here is on this chart, we plotted what was a 10-period moving average and a 20-period moving average. So just for those of you brand new to technical analysis, that's the red line is averaging the last 10 trading sessions, while the blue one is averaging the last 20 trading sessions. Therefore, the red moving average will always move faster than the blue, because the red one is averaging less data and therefore will be more responsive or quicker to react than will be the longer dated option. Moving average. Nonetheless, what you can see here on this chart is there was a crossover where that circle is right over here, that the red line crossed above the blue line, giving what is known as the technical analysis version of the buy signal. It is where there's an indicator to this trader to actually take or buy a position. Subsequently, notice that the red line remained, even during the correction in the middle of the chart, above the blue line, and only crossed the blue line, the red line back down below the blue line once it reversed off the top. What this moving average technique has now allowed a trader to do is to participate in the entire uptrend. Now, while I don't have Flight Desk loaded, if I was to just simply give you this chart on Agnico Eagle, and you see that 50-day moving average blue line, what I can assure you is that if we had a crossover of the two, that they would have stayed decisively bullish in their trend throughout that entire 6-month period from January to August. Actually, that's more like a 7-8 month period. Nonetheless, it would have stayed in the uptrend, and you would have only seen a bearish crossover on something like Agnico Eagle once it reversed off of the highs back in the summer of in August. Nonetheless, there are traders that like to utilize this moving average technique as a mechanism for buying and selling. Nonetheless, this is a very interesting technique that's available to all of you to be able to incorporate in your investing and trading. We'll talk about how we can use options with this in just a moment. Nonetheless, I wanted now to speak about support resistance levels. And the key observations I would make about support resistance levels is that the strength or weakness at certain price levels can be identified that as lows are formed and retested, they become support. Where to kind of give you an idea of how support occurs, let's say you saw Agnico Eagle trade from $80 down to $60, and you say, I think that's a buying opportunity, but before you could buy, the stock rallies from $60 back to $65. Now, you remember that the last time it traded down at $60, it was a buying opportunity. So now, if the stock was to fall from $65 back down to that $60 level, you remember that $60 was where you wanted to buy last time. What ends up happening with the markets is that whether it's fundamentally driven by a value investor that wants to accumulate a stock at a specific price, and or from a technical observation where there's enough traders making a key decision at a price level that it continuously is reversing the stock at that level. And whichever of the two that it is, as those lows keep retesting certain levels, we can identify it as a support line, which therefore we can make key trading decisions when we're pivoting around that support line. Now the reciprocal of that is the resistance line, where it is that as a stock rallies, as soon as it reaches a certain price level, every time it tries to rally, it seems to be distributed or sold at that price level, creating overhead resistance levels. Now more advanced technical traders will observe those things as double bottoms, inverse head and shoulders, or double tops and other types of overhead resistance. There's all sorts of different ways that this manifests itself technically on the charts. But by observing it, you'll see when we're getting into option writing, it allows us a valuable tool for being able to identify the kind of levels where we want to conduct trades. And so you can see here a perfect example here is a stock chart. We didn't associate it with a symbol, but it demonstrates what we were talking about, which is notice that the stock continuously retested the $17 level over and over again. Not only did it temporarily trade below $17 at the very beginning, but then retested $17 again. If I was to actually just illustrate on this chart here. So not only did it first create almost like a double bottom down along this 16.5, 17 level, but you can see that it retested 17, retested 17, retested 17, retested 17. And it's almost like every time that stock came to that, an investor was able to find a compelling level where there was an opportunity from a risk-reward perspective to test whether or not that support resistance level was a key turning point for the stock. Nonetheless, as the stock reverses higher, you can see that $17 was a key level where one could have made a core investment decision. Now, we'll see when we're talking about options as an income strategy, one could be selling whether puts or credit spreads or other things down below that support line, and or using that as a place to accumulate the stock from a covered call writing perspective. Now, obviously the reciprocal of that is the resistance levels, and what you can see in this on this chart example here is that the stock initially tested with this large shadow candle the $50 level in the early stages. After selling off, it basically retested that $49.50 level. After pulling back, retested that $49.50 level, pulled back and retested it again. And so what you can see here is the stock has demonstrated the characteristic of distribution, and eventually that was a point from which the stock broke down. And so you can literally be able to identify on a price chart that these overhead resistance levels are there, and that it is behaving or acting like resistance in a way that you need to be able to take advantage of that by whether you're selling covered calls at the higher strikes and or taking some profits up along the top strikes. The key thing is to use the overhead resistance levels as something to observe some of those key decision making. What I want to now talk about is the two ways that one can trade options. Obviously, there's option buying and then there's option selling. And the objective that any investor has is always going to be dependent on which of the two approaches you're using. Now, obviously, anybody who is using options for a buying perspective is seeking to be right about a directional price move. And that's a core thing that you want to be able to differentiate, because when we're selling options, you'll be able to take advantage of them in the different market periods as you're going through. So nonetheless, let's talk about some of this here. So the timing of an option purchase. Obviously, market timing is an important consideration when buying options. Again, you can't buy a 2 or a 3 month option based purely on value investing. You know, if you're buying something because you believe the stock is structurally cheap, well, that stock can remain cheap in its price for a year, 2 years. But when you're buying an option that expires in 2 or 3 months, there has to not only be an identification that the stock is cheap and that there's an opportunity, but there has to equally be a reason that you believe that the stock is likely to improve over the sooner versus later time horizon. So an investor can be fundamentally correct but not have allocated enough time in an option to profit. So longer term options, you can of course buy options that are 1 year, 2 years out, but one has to realize that it mitigates your investment return when buying that much time value. So for instance, you might be right, the stock might rise 10 or 20% over, let's say, the next year, but if you paid a 10% premium for the option, you may find that you've lost much of the upside potential in buying this very expensive long-term option, and therefore it's much more profitable to sort of be able to identify when you think the price move is most likely to occur, or at least if there's a probability that the breakout is occurring, and then using a shorter term option to be able to express that view. And so other observations about timing and options purchase. Technical analysis offers definitive signals for entry and exit, and technical analysis is typically used for market timing. Therefore, option buying and technical analysis naturally complement each other, and this is where you can use that to identify those entry and exit signals and other opportunities, right? And so, for instance, so let's talk about an entry signal. So obviously there are many uses of technical analysis to get trade signals. Now, some of you may have done already some research into technical analysis. Some of you use third-party signals. Some of you may take advantage of the Recognia technical screening software that is provided for you through Scotia and built right into their platforms, and subsequently some of you may just be using the most basic features using your own techniques. Nonetheless, one thing I always say about technical analysis, you must never forget that it's truly just derived from the only three real things that exist: price, time, and volume. Price, time, and volume, every indicator is just some mathematical computation interpreting price, time, and volume. And therefore, there's a redundancy and overlap in overusing technical and analysis techniques, because in the end, what you're seeking is some way to be able to make a more definitive buy or sell decision rather than just relying on something like fundamentals. And so technicals, you just need to find some mechanism to give you that entry signal. So the following examples demonstrate, for instance, a break of a key support resistance levels. You can observe that moving averages are supporting the directional bias. And as a general rule, the more evidence supporting the move, the higher the probability of being correct. And so notice here, when buying call options, you can see on this chart that there was a sell signal when there was a red candle. Now, for the more aggressive investor, they could try to profit from that move lower through something like short selling or the buying of a put option to try to profit from a directional move lower. Now, but really what most investors are waiting for is that buy signal. And you can see here that waiting that entire month of January from the sell-off, in the end you ended up receiving this buy signal over here as the candles broke above the moving averages, and subsequently that shorter term moving average gave you that signal. This is an example of a chart pattern where if an investor found value in using a technique like this, would use a call option as a vehicle to potentially participate on their belief that something is going to go higher or to the upside on that move. So you can see here, one could buy a call option on the breakout, and subsequently you can see that the next sell signal or the break below those moving averages could have been used as your exit signal. So now obviously, in full disclosure, this chart example is one obviously demonstrating where technical analysis worked. And it's sort of like data mining. I want to stress that not every chart pattern works out this way. There are periods where there are false starts or a signal comes early and then reverses quickly, forcing you out of a trade without making a profit or taking a loss. This is an example where the stock rallied from $44 up to a high of $52, $53. Very nice $9 advance in the stock, and one was able to participate along the way. Now, equally on a directional basis, you can see here that eventually this same stock, so you can see here that the sell signal occurred right over here, and that caused the investor to take profits and or exit the position. Now, whether you took this immediately as a short signal and you buy a put option, one can see that that another sell signal came in over here. Now, often this is an example of where an investor would have to close out a trade. If, let's say, you use the sell signal to get short this market back, like we said over here, notice that once that red line over here got back above, it told you to close the put option and to position yourself for an upside or along the opportunity and buy a call option. But subsequently, notice here, once this bearish engulfing candle came in on this red candle over here, it also gave a second sell signal, which then allowed you to participate by buying a put option on a move that took about a month to play out in September, October, where the stock dropped from $52 essentially down to as low as $44. And so you can see an investor was able to participate on much of the $9 rise higher, much of the $9 rise sell-off lower, and certainly did experience a couple of false signals, which may have resulted in short-term trading losses on short-term opportunities. Nonetheless, it's an example of how one can utilize technical analysis to make more definitive buy or sell signals. Now, you don't need to take sell signals. If you are a natural investor and you're looking for buy opportunities, all the sell signals are telling you to one manner or another is, for instance, if I owned a stock and I participated on the upside, I would feel compelled to use these sell signals to potentially buy a put option as a protective put on stock that I own. What that does is that it's like buying insurance on your stocks. Again, we have a great presentation we've done for Scotia on buying protective puts. If you want to learn more about it, you can certainly reach out to Rose, who will show you how to get the videos where we covered the strategies. Nonetheless, it's an opportunity using a signal like this to be able to try to market time these moves higher and lower, and potentially whether just to protect your positions and or position yourself to profit from each of those types of market moves. So the next thing I want to talk about is writing options using technical analysis, or the idea of covered call writing or selling puts. And so as a seller of options, you're trying to profit from an income perspective off of the sale of puts or the sale of calls. And so therefore, you're no longer market timing the same way that someone who buys options. And so this is what makes the options market so beautiful, is that as an investor, you can choose to be the seller just as easily as you can choose to be a buyer. Obviously, if you're trading a registered account, such as an RRSP for a Canadian, there are certain obstacles or restrictions that you will incur, but nonetheless, you have the opportunity to be able to position yourself depending on how you want to profit. Nonetheless, whether you're doing credit spreads, selling puts, covered calls, what your goal is to try to find key support resistance levels from which to do most of your business. So using a moving average to establish directional bias is always an interesting way of identifying a trend. But using support resistance levels is more important because you're trying to identify the strike prices for covered calls and or the strike prices for your selling of puts. And so as an example here, we have TD Bank shares. And what you can see here is that after the stock has found short-term low, we can identify that it has numerous times rejected at $53 and numerous times the stock rejected at $55. And so as a covered call writer, for instance, on TD Bank shares, one can use these any short-term rallies to sell calls into those overhead resistance levels and collect a premium for having done so. Now, similarly, when you're doing what's called a cash covered put, those not familiar with the strategy, by selling a put option, you generate an income for undertaking the obligation to have to buy the shares if someone wanted to sell them to you at a specified price. And so this is where a cash covered put needs to have a support line in context. So what do I mean by that? Well, if we look here, notice how Suncor back at the start of the year tested numerous times the $28 and $30 levels. Now you can see it tested back in 2014 and once again in the middle of 2015, $32 support level, and during the very sharp sell-off in January, it sold off as low as that $28 level. And so identifying where all these previous lows are gives you a mechanism from which to be able to identify the strike prices from which you can sell those puts and generate the income. So what we'll do is we'll definitely leave some room for question and answer, but I just want to leave you all with a few conclusions to kind of be able to garner. Is that technical analysis, I always observe it as a tool to complement a sound investment and trading plan. I never like to, I am a CMT by designation. A lot of our programs are associated with teaching technical analysis, but I never like to make it all about the technical analysis. The technical analysis is a tool from which allows us to be able to make much more sound decisions about how we are getting in and getting out and what price levels we're choosing and why we're choosing them. And so the use of price charts and the options allows you to be able to take time into consideration when making a lot of your core decisions. And in addition to that, obviously, moving averages allow you to make sure you're always on the right side of the trend. Understand you cannot have a stock in the midst of a downtrend while it's above its moving averages. It's just mathematically not plausible. I mean, pullbacks can go retest the moving averages, but a primary downtrend has to be done where the trend is below the moving averages. So you can use those moving averages as arbiters of trend. Often that 50-day moving average can prove to offer that. Establishing that. At the same time, identifying previous highs and lows, support resistance levels, allows you to time your entries and targets, as well as to choose what strike prices to sell your covered calls or sell your puts. What I want to do is just briefly take the opportunity very quickly to just show everyone a few quick things on the Montreal Exchange websites. Now, Montreal Exchange has spent a lot of time and effort and resources to provide a lot of amazing tools for you to complement so many of the amazing resources that Scotia iTrade offers all of you. And what I want to just show you is that when you go to the Montreal Exchange website, if you go under the trading tools, not only do they have a series of calculators and other things, they also have a great trading simulator. If you see where my mouse is toggling along the left-hand drop-down selection, when you click the trading simulator, it allows you to open a paper trading account, which you're able to turn around and be able to simulate buying and selling, and you overlaying options or doing covered calls or selling puts. It allows you to practice it with paper money along the way. But one of the things I wanted to show you is if you click under education, not only are there amazing strategy guides and tax opinions and all sorts of great stuff, but you can see where it shows here the options blog. And I wanted to just point out this blog because Montreal Exchange relaunched a fabulous new blog with all sorts of great articles on using options. And one of the really interesting things, I'll be posting a brand new blog very soon. In fact, by Friday will be my up-to-date blog article talking about some option strategy. Nonetheless, I wanted to really just point out that it's a great resource for all of you to stay in touch with the Canadian options market, and some really interesting things that you can observe in regards to the strategies. For instance, here, covered calls versus naked puts. It's one written by Richard Croft. Just talks about why you would choose one versus another. All sorts of really great little articles that all of you can pick up and read on that front. Nonetheless, amazing resources. Make sure you take advantage of not only the ones that Scotia offers you, but also the ones that Montreal Exchange offers you going forward. So with that, Rose, I'm going to let you take over here. I'll be happy to answer any questions. We have definitely a few more minutes to do so. But in the interim, while we're waiting, Rose, if you have any closing remarks or anything, feel free. Rose, I think you're muted still. At least I'm not getting your volume at this moment. I don't know if you're trying to speak there, but if you can just check your sound.
Patrick, can you hear me?
Absolutely. Welcome back, Rose.
Perfect, thank you. It seems like I was just talking to myself the entire time there. Okay, so I will just review what I mentioned earlier is that you can access our webinar recordings on our website, and also don't forget to fill out the short survey that will pop up after you exit today's session. And also mark your calendars. This Thursday, October 27th, we have the market guys presenting advanced option strategies and technical analysis at 1 p.m. Eastern Time. And Montreal Exchange is back with us again on Tuesday, November 23rd at 1 p.m. Eastern Time to present Understanding the Greeks. And you can also sign up for our other webinars on our seminar and webinar calendar under the Learn and Do More section. And again, webinars on demand for webinar recordings. And with that, I want to thank Patrick for sharing his insights, and thank you all for joining us. And also the handout is available in the handouts panel, and you can see the link available for you. And let me just check the question panel here in case anyone has submitted anything. So there is one from Sunny. He asks, can we write covered call on LEAP's long-term call options deep in the money?
Well, Sonny, that's a great question. First of all, you wouldn't be able to do that in a registered account. What you're referencing there is considered a calendar spread. And what that involves is you're using that long-term option as a synthetic stock position, and you are selling covered calls against it to attain leverage, which is a very viable way of doing that, but is just not available in registered accounts. So you need to get the appropriate options approval in a standard margin account that Scotia offers, and yes, you would be able to do that with the right options approvals.
Perfect. Thanks, Patrick, and thanks for submitting that, Sunny. And I don't see any other questions, and if you can think of any of them after today's session, you are welcome to send them along to education@scotiaitrade.com, and we would be happy to send that along to Patrick. Oh, I think Ravi has sent another question here. So Ravi says, I'm a beginner, so please forgive the potentially naive question, but could you comment on volatility? Is that part of technical analysis? And if so, how is it helpful?
All right, Ravi, again, a good question in regards to volatility. Well, the study of volatility trends is technical analysis, but volatility itself is simply a measure of the premiums that are being priced into stocks. Well, historical volatility is how volatile a stock has been in the past, while implied volatility is what the market is pricing in anticipation of volatility in the future. And so we can chart volatility. Often most investors utilize what's called the volatility index, or the VIX, or the VIX-C in Canada. And that is allowing us to observe major volatility trends as they're emerging. In general, volatility, trading volatility, or using volatility trading is something that is, I would say, a far more sophisticated strategy, because it's a derivative of options, and subsequently it's also a derivative of the market's perception on future volatility. And so it is a very sophisticated thing to be able to track. I would say for an average investor or beginner, it's more important to just observe what is the volatility when you're buying or selling. You generally have to recognize that if you're buying into a period of heightened volatility, you're paying a substantial volatility premium in buying. But as a seller of an option, you're certainly gaining a huge advantage in selling into a period of heightened volatility. So you want to make a general observation is what are the conditions of volatility when I'm making my option decision, but I wouldn't overread more than that until you're more of a sophisticated investor, which then would take a model of something more significant in the way you're making your buy and sell decisions.
Excellent. Thanks, Patrick, and thanks for submitting that, Ravi. If there are no other questions, I just want to say thank you again for joining us, and have a great rest of the day. Thanks, everyone.
Thank you, everyone.